You are one layoff away from financial collapse. That is not a dramatic statement. That is the mathematical reality for the majority of people who depend entirely on a paycheck to survive. Your salary stops the moment your employer decides it. Should stop a medical emergency, a corporate restructuring, an economic downturn, and that direct deposit disappears. And the terrifying part is that most people have built their entire financial existence on that single, fragile income stream with zero backup, zero plan, and zero passive income waiting on the other side. The wealthy do not live this way. They never have. The difference between someone who is financially free and someone who is financially trapped is not intelligence. It is not even how much they earn. It is that one group built income that runs without them, and the other group never did. Dividend investing through ETFs is how you build that income. It is not complicated. It is not a shortcut, and it is not going to happen overnight. But if you execute the strategy correctly and stay disciplined for long enough, the math works every single time. Before going any further, if this kind of financial breakdown is useful to you, subscribe to this channel right now. The research, the numbers, the fund breakdowns you are about to receive are the same quality of information that financial advisors charge hundreds of dollars per hour to walk clients through. This channel delivers it for free. Subscribing takes 5 seconds. If building real passive income is a goal you are serious about, this channel is where you need to be. Subscribe and stay with it. When most people think about making money from the stock market, they think about price appreciation. They buy a stock at $100, they wait for it to reach $200, they sell and they make money. That model has 3 fundamental problems that most people never think through clearly. First, there is no guarantee the stock goes up. Second, even if it does go up, you do not actually receive any money until you sell the asset. And third, the moment you sell, you no longer own the investment that was supposed to build your wealth. You are back to zero, looking for the next thing to buy. This is the cycle that keeps most retail investors permanently behind, endlessly chasing price gains they may never fully realize, with no income in the meantime and no compounding working in their favor, and dividends solve all 3 of those problems at once. When a company generates large profits, it has a few options for what to do with that money. It can hold it as a cash reserve, it can reinvest it back into the business through expansion or research and development, or it can distribute a portion of those profits directly to shareholders as a cash payment, a dividend. That cash gets deposited into your brokerage account, typically every 3 months, and you do not have to sell anything to receive it. The stock can be going up, going down, or moving sideways. The dividend still gets paid as long as the underlying company remains profitable and committed to distributing that income. You own the stock, you collect the cash. That is the entire mechanism. Now here's where the strategy becomes genuinely powerful. If instead of spending those dividend payments, you reinvest them back into the same fund, buying more shares, which produce more dividends, which buy more shares, you trigger a compounding cycle that builds on itself continuously. This is called a dividend reinvestment plan, or DRIP, and the numbers it produces over a long time frame are the reason. Serious long-term investors treat it as the foundation of their entire wealth-building strategy. The math is straightforward. If you invest $1,000 per month into a savings account, growing at 0%, after 30 years you have $360,000 in zero monthly income. If you invest that same $1,000 per month into the stock market and earn the historical average return of approximately 8% per year, but with no dividend income, you retire with roughly $1.5 million in total portfolio value. That sounds impressive until you realize that to actually spend it, you have to sell pieces of it every month. And at some point, the math runs dry. But now, take that same $1,000 monthly investment, the same 8% average annual growth, and add a 4% annual dividend, with a DRIP strategy where every dividend payment gets reinvested back into the fund. After 30 years, your portfolio is not worth $1.5 million. It is worth just over $3.1 million. And the monthly passive income from dividends alone income, you do not have to sell anything to receive, is approximately $11,700 per month, same monthly investment, same 30-year timeline. The only difference is the strategy. Before getting into specific funds, there is a mistake that derails most people who try dividend investing, and it needs to be addressed directly. When people first discover dividend investing, they immediately search for the highest yielding stocks available. They find something paying a 12 or 15% annual dividend, and they assume they have found a money printer. Almost always, they have not. An abnormally high dividend yield is typically a warning signal. It usually means the stock price has already crashed, making the yield appear inflated, or the company is paying out more than its earnings can sustain. which means a dividend cut is coming and the stock price will drop when it does. Either way, the investor who chased that yield ends up with less income and less capital than they started with. This is why the funds covered here are ETFs rather than individual stocks. An ETF, or exchange-traded fund, is a basket of dozens or hundreds of individual companies bundled into a single investment. When you buy a share of a dividend ETF, you instantly own a diversified slice of an entire portfolio of dividend-paying companies. If one company inside the fund cuts its dividend or goes under, the fund rebalances and replaces it. Your income stream is not dependent on any one company's performance. The risk is distributed, the management is built into the structure, and the compounding still works. For investors who are not full-time analysts tracking individual company earnings reports every quarter, ETFs are the more rational vehicle. The first category is the most straightforward: core United States dividend growers. These are ETFs built on large, established American companies that are not just paying dividends but consistently increasing them year over year. And the focus here is on stability and growth of income rather than maximum current yield. The first fund is SRIB, the Schwab U.S. Dividend Equity ETF. SRIB targets high dividend-paying U.S. companies with a documented track record of growing their profits and their dividends over time. The current annual dividend yield is approximately 3.4%. Over the last 10 years, the dividend itself has grown at an average rate of 10.6% per year. That dividend growth rate is the critical number. It means the income this fund produces is not fixed. It is growing at over 10% annually, which means in roughly 7 years, the income from an initial investment has doubled without any additional capital being deployed. The second fund is DGRO, the iShares Core Dividend Growth ETF. DGRO has a slightly broader selection criteria, requiring 5 years of consecutive dividend growth from its holdings, rather than 10, which opens the portfolio to a wider range of companies. Current yield is approximately 2.4% with a 10-year average dividend growth rate of 8.6% annually. The third is VIG, the Vanguard Dividend Appreciation ETF, which specifically targets companies that have raised their dividend every single year for at least the past decade. The current yield is around 1.5%. which is lower than SEHD or DGRO, but the trade-off is a higher quality filter on the underlying companies. Dividend growth has averaged 7.7% per year over the last 10 years. The fourth fund in this category is VUIM, also from Vanguard, which prioritizes higher current yield rather than appreciation rate. VUIM currently yields approximately 2.3% annually, with dividend growth averaging around 6.5% per year. If the goal is slightly more income today with a modest reduction in growth rate, VM provides that balance within the same U.S. large-cap dividend universe. The second category moves outside U.S. borders entirely, and this is where a significant number of domestic-only investors leave real income on the table. International markets carry more currency risk, more geopolitical exposure, and more volatility than domestic markets. They also contain companies generating extraordinary cash flows that are being returned to shareholders at yields that U.S. companies frequently cannot match, particularly in developed markets across Europe and Asia, where dividend culture among corporations is structurally different from the American model. The first international fund is VYMI, the Vanguard International High Dividend Yield ETF. VYMI targets high dividend-paying companies outside the United States across developed and emerging international markets. Current yield is approximately 3.5% annually over the roughly 8 years of data available. Dividend growth has averaged approximately 8% per year. International diversification through a fund, like VYMI, does not replace domestic holdings, it complements them, spreading income sources across multiple economies and currencies so that the portfolio is not entirely dependent on the performance of the U.S. economy alone. The second international fund is SQI, the Schwab International Dividend Equity ETF, which focuses on international companies with a specific emphasis on dividend growth rather than just current yield. SQI is a newer fund with a shorter performance history, but current yield sits at approximately 2.3%, with dividend growth averaging 8.28% annually based on available data. As this fund accumulates a longer track record, it will become easier to evaluate its consistency, but the underlying strategy aligns with what dividend growth investors are looking for. The third category narrows the focus to what are called dividend aristocrats, and this is where the concept of track record becomes the central criterion. A dividend aristocrat is a company that has paid out and increased its dividend every single year for at least 25 consecutive years. 25 years that covers multiple recessions, a financial crisis, a global pandemic. and several significant market corrections. Any company that maintained and increased its dividend payment through all of that has demonstrated a level of financial durability that most companies simply cannot claim. The first fund here is NOBL, the ProShares S&P 500 Dividend Aristocrats ETF. NOBL combines two requirements. The company must be a member of the S&P 500, meaning it is among the 500 largest publicly traded companies in the United States, and it must be a dividend aristocrat with at least 25 consecutive years of dividend increases. Current yield is approximately 2.3%, with a 10-year average dividend growth rate of 8.5% annually. The companies inside NOBL are not exciting. They are not the names generating headlines about explosive growth. They are the names that have been quietly compounding shareholder wealth and raising dividend payments through every economic environment the last quarter century has produced. The second fund in this category is DGRW, the WisdomTree U.S. Quality Dividend Growth Fund, which targets U.S. companies with strong fundamentals and an aggressive dividend growth profile. Current yield is approximately 1.3%, which is the lowest current income of any fund discussed so far, but the dividend growth rate over the last decade averages 13% annually. At 13% annual growth, a dividend payment doubles in roughly 5.5 years. The lower starting yield is the price of access to that growth rate, and for investors with a long enough time horizon, the math strongly favors the growth. The fourth category is mid-cap companies, and this segment of the market is consistently underutilized by dividend investors who tend to focus exclusively on large-cap names. Mid-cap companies are those valued between approximately $2 billion and $10 billion. They are not startups burning through cash in pursuit of future profitability. They are established, profitable businesses, but unlike the mega-cap giants, they have not yet maximized their growth potential, which means their earnings can expand faster, and when earnings expand faster, dividends tend to grow faster. The first fund is REGL, the ProShares S&P Midcap 400 Dividend Aristocrats ETF, which applies the aristocrat framework to the midcap universe, targeting companies that have increased their dividend every year for at least 15 consecutive years. Current yield is approximately 2.4%, and the 10-year average dividend growth rate is 11.6% annually. That combination, current income plus nearly 12% annual dividend growth, is a compelling profile for investors who want both present income and substantial future income growth. The second mid-cap fund is PEY, the Invesco High Yield Equity Dividend Achievers ETF, which focuses on companies with a history of not just growing dividends, but also growing their stock price. Current yield sits at approximately 4% annually, minus current income yield of any fund in the first four categories, with dividend growth averaging 8.1% per year over the last decade. PEY tilts more toward income today while still delivering meaningful dividend growth over time. For broader mid-cap exposure, without strict aristocrat requirements, DMDV from WisdomTree provides access to the wider mid-cap dividend universe. Current yield is approximately 3% annually, with average dividend growth of 5.9% per year over the last decade. It is a less selective filter but a more comprehensive exposure to mid-cap dividend payers. The fifth category is the highest risk of the group, and it is important to understand precisely what is being traded for the elevated income it produces. Covered call ETFs generate income through an option strategy rather than purely through company dividends. The fund holds a portfolio of stocks and simultaneously sells call options on those holdings, collecting a premium fee from options traders in exchange for agreeing to cap the fund's upside if the stock rises above a certain price. That premium income is what gets distributed to shareholders as a dividend-like payment. The result is a significantly higher current income yield than any of the previous categories. The cost is that in a strong bull market, the fund's gains are capped, and the income itself does not compound and grow the way traditional dividend income does. It is an income instrument, not a wealth-building instrument. And that distinction matters enormously depending on where an investor is in their financial journey. The first fund in this category is JEPI, the JP Morgan Equity Premium Income ETF, which holds S&P 500 companies and generates premium income through its options overlay strategy. Over the last 12 months, JEPI has generated approximately 8.2% in income. The second is JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF, applying the same covered call strategy to a NASDAQ concentrated portfolio, generating approximately 10.5% in income over the last 12 months. For investors who need significant current income immediately, perhaps those who are already retired or those who are very close to it. These funds serve a specific and legitimate purpose. For investors in the accumulation phase with decades ahead of them, covered call ETFs work better as a smaller allocation within a broader portfolio rather than as the primary holding. Every fund category covered here, every yield figure, every dividend growth rate, none of it produces the outcome described earlier without one discipline being maintained, without exception. Consistent, continuous investment, regardless of what the market is doing. The strategy is straightforward. Invest every month, reinvest every dividend, and do not stop when markets fall. This last point is the one that separates investors who actually build the income they set out to build from those who stay stuck. A market decline is not a reason to stop investing in dividend ETFs. Mathematically, it is the best possible environment to accelerate investment because when prices drop, the dividend yield on new purchases goes up, and every reinvested dividend buys more shares at the lower price, which accelerates the compounding recovery when prices recover. Every investor who sold out of a quality dividend fund during a market crash locked in a loss, forfeited their shares, and had to start the compounding process over. Every investor who kept buying through the decline came out the other side with a larger position, higher income, and a portfolio worth significantly more than if the crash had never happened. Market crashes are not emergencies for dividend investors who own quality ETFs, and they are accelerants. The only scenario where market crash destroys a dividend investor is if that investor sells. Here's where everything discussed in this video either becomes real or stays theoretical. And that depends entirely on what happens after you close this tab. The math behind dividend investing is not complicated. Invest consistently, reinvest the income, hold quality funds with documented dividend growth histories, give it time. These 5 categories, U.S. core dividend growers like SAHD, DJRO, VIG, and VYM, international income funds like VYMI and SWAY, dividend aristocrat funds like Noble and DGRW, mid-cap dividend growers like REGL, PAY, and DMBV, and covered call income funds like GEPI and JPQ for those who need current income. These are not speculative bets. These are documented, data-backed instruments built on profitable companies with long track records of returning cash to shareholders. The $11,700 per month in passive income shown in the compounding example earlier is not a fantasy. It is the output of a 30-year drip strategy at a 4% yield with 8% average annual growth. The numbers are the numbers. The only variable is whether you actually execute the strategy consistently over a long enough period or whether you get distracted, get scared during a downturn, and stop. Most people stop. The ones who do not stop are the ones who eventually stop needing a paycheck.